Welcome back to the Personal Finance Project. Scott and I are doing a somewhat emergency broadcast that is tax planning centric. And we're really just addressing the highlights of the One Big Beautiful Bill Act because it has some pertinent changes or some changes that are going to be germane this year. A lot of these things actually take effect in 2025. We'll talk about those. We'll talk about some of the things that haven't changed. And then we'll talk about some of the things that will change in 2026 and how that might pertain to our listeners' tax planning. So, Scott, I thought it would be helpful if we began really with what didn't change, because I think a lot of people in the lead up to the election were kind of worried that we would have that sunset.
Yeah.
It was bearing down on people, especially from an estate tax perspective and also an income tax perspective. So maybe we just begin not by necessarily going into the new provisions, but some of the provisions that we still have today.
Yeah. So I'd say that the first comment I would make on that is that the tax brackets are unchanged. So we still are in a better situation than we were, say, in 2015, 16, where there's a good bit of income that's going to fall at 10, 12, 22, 24% brackets, which that was really kind of where the benefit kicked in, because that 24% that was pretty wide in the tax brackets, that was replacing 25 and 28 for a pretty good amount of income. So that saved people in that kind of middle to higher income area.
Yeah, and the 35 bracket is considerably wider under this code or regime, however you want to talk about it, versus previously where it seemed as though prior to the very top marginal bracket, it was a very narrow band, and the 39.6 kicked in at lower rates of income than the 37 kicks in.
And that was also, I think, in the kind of the marriage penalty phase of that older code, where it was especially narrow if you were married as opposed to if you were single. It was a little bit bigger.
Okay.
But I would just also add that, and as you just said, the top bracket now 37% as opposed to 39.6, which is the same as where we're under, but there was the possibility that it could have gone up if this was not renewed.
Sure.
So that is a component. And then I'd say the biggest thing for probably retirees, especially, if you've accumulated a good bit of assets, is that we're looking like the estate tax exemption is going to be $15 million per person beginning next year. So what that means is that a married couple, the first $30 million that exits your estate after your passing is not going to be taxable by the government.
Yeah.
So, I mean, what that really does is it opens you up to a lot of planning that you can do, or you just don't need to do that much planning unless you are getting really, really far towards $30 million. Things that we've talked about in the past, like irrevocable life insurance trusts or family limited partnerships, they're just probably not necessary if you are, well below that $30 million area.
Yeah. For the mass affluent, it seems as though this is going to be a kind of business as usual where the number of individuals or number of households actually paying estate tax is going to remain quite low.
Yeah.
And then the strategies we saw people kind of rushing to employ back when we thought that this might sunset, the slats and the FLPs and the ILITs and all the rest, that, as we talked about with Darian, was kind of an example of how you can overplan for some of these things. And I do want to point out that, because this is very confusing language, permanent in terms of changes to the tax code means until it's changed.
I was going to say, I mean, it would be very difficult to see any of this changing before 2029. But I mean, who knows what the next couple of elections bring, and maybe the pendulum swings the other way and there's a new tax code in 2029. It's possible, but for now, I think we've got the next 5 years pretty well accounted for.
Yeah. So permanent means it will remain unless changed, and temporary means it will remain until a point in time unless we decide to do something
until we extend it.
Exactly.
At that point.
So like the Tax Cuts and Jobs Act contained a number of temporary provisions which have now been made so-called permanent, and now there's a number of permanent provisions that could very well be changed. So just I would say be encouraged if some of these things are not necessarily changes you'd like to see, because virtually every element of the tax code is subject to change. And we're actually going to touch on that a little bit, because there are some changes that will kick into effect this year that essentially Congress changed the game of tax planning in the middle of the game, July the 4th, almost exactly the midpoint of the year. And if you had done some tax planning earlier in the year, you might be missing out on some deductions that only just now became available. But this is kind of what they do all the time.
Yeah, it is. So which of those deductions that change do you think are maybe of interest to our clients?
I think the one where, and again, this isn't going to apply to terribly many people because the phase out is pretty high. But the thing that grabbed my attention for itemizers, also kind of a select group of people, would be the new increase in the availability of the SALT deduction.
Yeah.
So in income tax-free states like Texas or Florida or Washington State or some others, not as big a deal unless you're in a very high real estate tax area. And there are some places in those states that are, but the new SALT deduction, where the maximum available deduction is now $40,000, where it was previously $10,000, but you get a phase out starting at $500,000 of income, and that would be totally phased out by $600,000 of income. So essentially, for every dollar over $500,000, you're losing 30% of the deduction. You still get your $10,000, but clearly if you're an itemizer and that had not been available to you, you're probably going to want to maintain that deduction because that's a significant reduction in your total taxable income.
Yeah, and I would say that this is one where it does look like it was kind of a I don't know if you want to say a gift or a nod to states with higher
Income
taxes.
tax, yeah.
Where if you're in a state like Texas and the only things that you have that can contribute to this are mortgage interest and property taxes, it's going to be tough to get to 40,000 unless you're making over 500,000.
Yeah.
So it's kind of a, okay, this sounds kind of nice, but to have a mortgage that aggressive, I mean, maybe you did really, really well and then you don't spend a whole lot in retirement, so it could work for you. But I think generally what we're going to see is in Texas, it's probably not going to help that much if you have all the way up to $40,000 of a deduction.
Yeah, and people might think that with this new increase in the SALT, you're going to see a overwhelming number of people re-entering the itemizing space. But again, you're also seeing an increase in the standard deduction. And by that, the increase is also, it didn't revert back to what it was going to be previously, which would have cut it roughly in half. And the standard deduction beginning in tax year 2025, now for a married couple, is $31,500. So it still takes a overwhelming amount, and particularly in low tax states, of either mortgage interest or charitable giving in order to get to itemization. And so that SALT deduction for people who had ordinarily been taking the standard, probably also not that big a deal because you're probably quite likely to maintain your standard status unless, like you said, not you particularly, you're in an unusual case where you have a very valuable piece of real estate upon which you have a large mortgage but weren't previously itemizing. So that would be kind of an unusual situation.
Yeah, no, I would agree with you on that. And then this was one that it sounded like you had a little bit more on beginning next year. Even if you're not itemizing, you can take kind of a de minimis charitable gift. Is that what I understood?
Yes. If you're single, you can take a $1,000 charitable deduction, and it's not going to be subject to the new charitable floor that we'll get into. And if you're married, you can take a $2,000. The way that it was described is essentially kind of like a personal exemption. It's saying if you're giving to charity, you can take your standard deduction, but you can also take another $1,000 on top of that to lower your total taxable income as a single, or $2,000 if you're married. So that's a 2026 provision.
That's interesting, and I think it's kind of a behavioral study, because one of the things that we've talked about a little bit and with clients is, because the threshold with the SALT deduction much lower made it to where you had to give a lot of money to charity to be deducting. I think it just kind of reduced the interest for some people. So I kind of like this where it's saying, okay, if you're not going to give $20,000 a year to, or $30,000 a year to the point where you're going to be able to itemize, we're still going to give you a little bit of an incentive to be charitable. I like that.
Yeah. I mean, we had a lot of people who were kind of in that strange income range where they, like you said, they had been very financially responsible, said they'd paid off their home by the time they were retired. They didn't have mortgage interest. Their SALT just capped at $10,000 didn't really do it for them, so they're taking the standard, but they're still charitable. They're just not that charitable. I mean, that's a significant sum of money you got to be giving to charity every year. So it is nice that now your first $2,000 of gifts are going to be tax deductible. So yeah, I like that. And then I suppose since we're on the topic of charitable, what will change in 2026 as well is they've introduced a new AGI floor beyond which you need to go in order for your charitable gifts to become deductible. And I know that was a mouthful, but what that will mean in practice is the first 0.5% of your adjusted gross income, you're going to take that number, and then So if you have $100,000 of adjusted gross income, the first $500 of that, I believe my math is correct on that.
Mm-hmm.
The first $500 that you give to charity will not be tax deductible. So only gifts in excess of that $500 that you're making to charity will become eligible for tax deductibility.
It's the buy-in.
It's essentially the buy-in. And it's kind of like what we talked about before, where it's going to be interesting to see how this shakes out, because this will militate against people becoming itemizers, because they've just now raised the amount that you have to give to charity in order to get yourself in the itemizing camp. With this new addition of this sort of AGI floor on charitable giving, though they've also given you the gift of some other itemizable deductions, SALT, which we just discussed, but it's really hard to say how this is going to work out kind of in aggregate for people.
Yeah, and I think that's an interesting comment, because I was mentioning this on another provision that we can touch on briefly. It's not that important, about deductibility of auto loan interest. To some degree, I feel like there's a few places in here where it kind of seems like the deductions are valuable, but if you're going to use the full deduction, you probably are within the income phase out.
Yeah,
so it's like,
exactly.
It's going to be a little bit of a struggle to find your way to actually utilizing all of it.
Yeah,
to me.
Yeah, you'd have to be quite unusual along a very specific dimension to qualify for some of these, because you're right. You wouldn't ordinarily have $10,000 of auto loan interest if you weren't making very much money.
Yeah.
Or you probably need to come see us if you do.
If you are.
So, but that kind of covers. And I think one other thing to mention on the charitable front is qualified charitable distributions, or QCDs, were not conspicuously absent. They were just absent this. So as far as we know, the qualified charitable distribution not subject to this 0.5% of AGI floor. So that means every dollar that leaves the IRA going to a qualified charity, sufficient that you're 70 and a half years old, you're still getting, that's not even going to hit your adjusted gross income. So that's not going to hit your income at all. And this might push more people to start doing their qualified charitable distributions as soon as they are of age, even if they had previously been itemizing. Now that you're going to have this 0.5% floor, you've got to meet against your AGI before those gifts start becoming deductible. And then the other thing that they did, and this isn't specific to charity, is starting in 2026, I believe, your maximum deduction, or the maximum available deduction if you're itemizing, caps out at 35%. And that sounds very confusing, but really what it's saying is if you had dollars that ordinarily would have been taxed at 37% and you've itemized those away, your maximum deduction against those dollars is truly 35%. So if your marginal income was $10,000 and you gave $10,000 to charity, previously your tax savings would have been the $3,700. That's going to now cap out at $3,500. So that's a little bit of a confusing provision in the bill, only going to apply to people who have, itemized deductions they can take against the top ranges of income. Very, very small number of individuals, but it is probably going to show through on their total tax liability starting in 2026.
Well, on the other side of that coin, we're not having the top marginal rate to go to 39.6.
Yeah. So it's, again, you got a little, you gave a little.
You gave a little bit.
Yeah.
Okay. So I think moving on, I was just going to touch briefly, I don't know if it's really going to affect a lot of the people that we work with, but just a couple of the hot button topics that were talked about a lot in the run up to the election. Could you just
that doesn't sound like Donald Trump.
What? Why don't we just spend a little time on stuff like overtime, tip income, and then the one that is probably the most applicable to our clients is the deduction for seniors, which is kind of a offset for the Social Security is not non-taxable, but this should help.
Yeah. I think that if we begin where most of our client base is with the new senior deduction, this is kind of an unusual one in as much as you still have to meet the qualifying test. So this is subject to a phase out. And I believe for married couples, the phase out for the new senior deduction begins at $150,000 of adjusted gross income, and you're totally phased out at $250,000 of adjusted gross income. However, this new deduction itself doesn't work to reduce your adjusted gross income.
Yes.
Which is somewhat confusing. So just for the benefit of the listener, the total available deduction for a married couple in addition to the standard deduction, by the way, and in addition to the $3,200 that you get being 65 years of age or blind. These are all, you can take all of them at the same time. Is $6,000 for single, $12,000 for married individuals. However, they're not above the line deductions and they're not explicitly below the line deductions because you don't have to be itemizing to take them.
It's almost like a deduction test.
It's like an on the line deduction.
Yeah, so it is a deduction, and I would say it is above the line technically, but
it doesn't reduce
it
your
doesn't
AGI.
reduce the number above the line.
So I think by way of example is if you thought you might be qualifying for this deduction because your adjusted gross income was $255,000, but you're saying, oh wait, if I get this senior deduction, my adjusted gross income drops down to something closer to $243,000. Not the case.
That's not how it's going to work.
You're zeroed as soon as you get to $250,000.
Yeah, the way I see this working in practice is up to age 73, I think what it's going to really do, or 75, depending on your age and required minimum distributions beginning, I think what people are going to do is just really be looking at, all right, what's the most amount of income I can produce from Social Security, pensions, IRA distributions, and still get 100% of this deduction.
Of the deduction.
And so I think what this is kind of a conversation that we have a lot. It's going to be very nice to have a blended source of income so that you've got some money, say, in a Roth, some money after tax, and some money in an IRA so that you can kind of pick and choose to get the most tax efficient income stream.
Yeah. And I think that this is kind of a shot across the bow, maybe more subtle than that, at Roth conversion, because I think what's going to become very difficult for advisors, for clients in particular, is really figuring out what the cost of an additional dollar of income is going to be. Because a lot of people think that the highest you could pay for one more dollar of income is 37%. And that's true in one sense, in as much as the top marginal rate, or the tax that you are going to pay on your next dollar, does stop at 37%. But what is not being demonstrated by that marginal rate are deductions that you would then lose by taking that additional dollar of income. So I think that makes tax planning even more pertinent to a client situation, even more important, because by way of an example, if you had $500,000 of adjusted gross income and did a $100,000 Roth conversion, you've now lost a available $30,000 of tax deductions because you phase yourself out entirely of the new SALT. So it's saying that's a very expensive Roth conversion for that person, much more expensive than 37%, because now you don't get that $30,000 deduction you would have previously qualified for.
You know, and I wonder, this is just speculative and I haven't run the numbers, but I wonder if this is going to lead people to look at doing Roth conversions later in life, unless your required minimum distributions are massive. You know, say you get to, RMD, say you have a $200,000 RMD, which we see is, that's a number that's feasible. You don't do Roths earlier because you're trying to stay with deductibility on these $6,000 senior credits, so to speak. But then once you hit RMD and you can't really stay below that number, that's when you do your Roth conversions, if you want to.
I'm also wondering if it might do somewhat the opposite, where now people who are over 65 have access to their retirement accounts, both Roth and otherwise. They might feel compelled to maybe supplement their income streams with some Roth distributions.
Yeah, and that's one of the things we talk about quite a bit, is the Roth being a little bit of a movable object or an untouchable black box, so to speak.
Yeah.
But maybe this brings it into use case a little bit more.
It could be, because if you think about keeping your effective tax rate super low, if you're one of those people who's now over 65, you've got a Roth balance, maybe you did some conversions in that golden window of planning we talk about post-separation, pre-Social Security. Now you're 65, you might be thinking, well, hang on a second. If I can distribute from my IRA and collect Social Security and get myself up closer to that 150,000 mark, where we still qualify for this full senior deduction, what would stop me from going to my advisor and say, hey, look, we want to take a trip, we need to buy a car, or we just want to supplement our income a little bit. What about taking the next $20,000 or so of income from the Roth?
Yeah.
Because then it doesn't even hit our adjusted gross income. It's tax-free, and we secure this other $12,000 deduction. There could be a lot more in terms of Roth distribution planning rather than just conversion planning now that these things are going to be available to people.
Yeah, and I think that's the case where you're talking about where that, say, $20,000 might be taxed at 35% instead of 24%,
Yeah.
or something around there. So at that point you say, all right, I will have a little bit of future value loss with the Roth, and I'm okay with that because I'm saving so much in taxes now.
Yeah, and again, you're retouching on what we just talked about, where it's not as simple as saying your Roth conversion will cost you 22%. It's saying, well, hold on, what are the deductions we're losing as a consequence of that? And now with that income phase out being, I wouldn't say low, I'm not going to turn my nose up at $150,000 of adjusted gross, but if you're living in retirement on $12,000 a month, this seems like a reasonable budget for many of our clients. You're bumping up against that if you're using IRA distributions and taxable Social Security, 85% taxable Social Security receipts. So I think Roth distribution planning really might become a new topic that we're going to be going over with clients.
A brave new world of Roth distribution.
Yeah. All right. Do you want to touch a little bit on, because we were talking off air about how we thought there might be some clever reassignment of income to tips now because you have this $25,000 deduction that you can take. It's not tax-free. Tip income is not tax-free as was, I'll say, maybe promised, or I would say alluded to. But there is a deduction available, $25,000 worth of a deduction. I believe that's for married couples.
Yeah, $12,500 per person.
On tip income. So
yeah, and so this is going to phase out as everything does. It seems like in these new provisions, in the 300,000 to 550,000 range. So it's a pretty big phase out area for overtime. And then for tips, pardon me, I think I might have switched topics on you there, but they both have a $25,000 maximum.
And I think they do start to phase out at $300,000 for the tip income as well.
Yeah, that's true. So both of those, I don't know. My thought on the tips is it may have some previously unreported income become reported, as opposed to it really changing a ton of behavior in terms of, are people going to want to work more hours in a tipping position? I'm not really sure.
Or it creates this weird reversal where ordinarily you'd want to take your tip income in cash. Now you might want to take your W-2 income in cash and just report all your actual earnings as tips.
Yeah.
So that you can get paid in cash for your actual labor, and then you can report your tips up to a certain amount and secure the $25,000. This is all speculative, and this isn't these are not things that we're condoning people do. Like, you should never underreport your income.
Yeah, but it does seem like there's going to be a lever here where, if you get temp income and, or just say an hourly wage, there's probably going to be some gaming of this system.
I would imagine so.
Just from, say you're a restaurant manager and you want to get your employees the best results, you pay them a certain amount in tip, or
you recategorize.
Yeah, you recategorize a little bit of money potentially.
And similar for overtime. So you get a deduction for overtime. Now, where this could get interesting is I'm not sure how tips while working overtime works. I don't know if there's a significant overlap there, but these are all things that kind of are going to be worked out over time. And then I think maybe bringing it back to where there might be some interest from our clients, the new Trump accounts.
Yeah.
So this was something that I felt like we might touch on. One, I think people are going to love the name, kind of depending on where you fall on the political spectrum.
Love or hate the name.
Exactly. Yeah. It's gonna set up. I think some people will feel like they are the best accounts of all time, and then others will just, they'll deride the accounts to begin with. From where I sit in terms of how I think people might use these accounts, a lot of uncertainty. So the question, I think the real question is, there's this $1,000 that the government is supposed to be putting into these accounts somehow. And that sounds like a technical thing, but I don't understand how it works practically. Do you establish a link with your custodian between you and the Treasury?
Yeah, who is the custodian of these accounts?
And how does it come in?
How is it reported? Yeah,
and I think some people might have some real hangups with having the government being a party who has at least one-way access to the account. So I don't know how people will feel about that, and I'm not sure exactly what the mechanism will be. And then I think the maximum amount you can put into these accounts per year is $5,000. They do not prohibit you from also going ahead and contributing to your IRA or your Roth IRA, or your 401k or anything of that variety. So this does not preclude you from just making typical contributions to other retirement style accounts. And then the way that these grow, kind of a mix, I suppose, between a Roth and a traditional, whereas every dollar that goes into these accounts is considered after tax, but all the growth on those dollars would be considered pre-tax. I believe these turn over to the minor at age 18, but then once they turn over to the minor, they can't take a distribution of the earnings. I'm not sure how they would access the principal. That's not written into
Yeah, it's not clear on if you would get the Roth rules on
the
a principal distribution or not.
or whether the distributions are going to be prorated like they would from a non-qualified annuity, or if they're going to be, contributions, conversions, and then earnings like a Roth. So there's a lot of speculation there. And then the other question is, will they aggregate these accounts in retirement like they do IRAs, where you'll have a mandatory distribution associated with this account?
I think the distribution rules are going to have to be clarified, because it strikes me as this is going to be an IRA with basis, which, from my experience, not fun.
No.
Because every single distribution you're having to understand exactly what your basis is and what percentage of this distribution is taxable versus a return of principal. That is going to be a nightmare for keeping track of for tax purposes if it's not clarified.
And then in the calculation for expected family contribution for things like financial aid, I don't know how these accounts are going to weigh in. So I know if you have an UTMA or an UGMA, sometimes people will say, oh, you shouldn't do that because that's considered an asset of the minor, and then when they get to the age of majority, it's considered their money, and that can make them less likely to qualify for things like financial aid. I don't know how these things are going to be considered, because I know retirement accounts are held off kind of like in a special part, or they're not counted as heavily in that expected family contribution calculation. No verbiage, as far as I'm aware, in the bill that indicates how these Trump accounts will affect a person's ability to qualify for financial aid. And for some people, that's an important consideration. And then kind of like you said, when we're talking especially to young people, although not necessarily only young people, we try to have them look at various accounts in terms of how much optionality is embedded in this account. You and I are pretty pro Roth for people who are starting out in their career, because the Roth IRA presents somewhat of a quasi two-way door. And by that we mean if you put some money in it and you absolutely need to get it back, there's a certain amount of that money you can get back tax-free, penalty-free, 100% of the time.
Yeah, it's a nice introduction to, say, a non-401k
it's an
investment.
It's a sensible way to save. Now, what we caution people on with things like the 529, powerful incentives to contribute, because you get tax-deferred and then sometimes tax-free growth. However, one-way door. If that money goes in and if you need it back the next day, you can be kind of in a pickle, and they didn't even give you the benefit of an upfront tax deduction in non-income tax states.
Yeah, at least federally.
Yeah, so you and I, for people of a certain income range, and this would be germane to the discussion on whether or not young people should start funding Trump accounts for their kids or older people for the grandkids, saying, well, we're going to compare it to a taxable brokerage account.
Yeah, I think that's probably the way to do it. The one thing I do kind of like about it is, I feel like for ages, especially, say, wealthy people have been trying to figure out how to get like IRAs and Roth IRAs open for children that don't work. And to be honest with you, I kind of like that it takes that appeal off. It's something else that you can turn to, and it doesn't require you to do something kind of nefarious, like, pay your 12-year-old
out of a family business.
Yeah,
that's like on paper only. Yeah.
My personal opinion, but it does seem like that's popular.
Yeah. And the other thing that we discussed previously was we have these provisions written into the code for catch-up contributions, but we don't have anything written into the code for get-ahead contributions.
No, and that's what I like about this.
Yeah, this represents a way to really accelerate retirement planning, because we have this, I would say, there is, some people would regard it as a crisis in this country of underfunded retirement accounts.
Mm-hmm.
And that could be a strain on the state. Obviously, that's not a good situation to be in. So I do like that we're kind of addressing that compounding is really most powerful early in life. And so this catch-up contribution, or now the new super catch-up contribution for people who are age 60 to 63, it's like, well, great, but the growth that they're going to get on that account between age 60 and 63, and then whenever they retire, it's just not that compelling.
Yeah.
I mean, that would be way more useful saying you have a super catch-up contribution in your 20s. And this is a kind of a super catch-up contribution for retirement funding well ahead of that. So pretty positive on that front.
I agree. This is, just a complete aside, but I will say that people who think that the government has a role in trying to keep the S&P 500 inflated are in shambles right now, because they're very encouraged to think that we're trying to provide a bid for the market right now with the way that these accounts work.
Sure.
You can only buy the indexes, and you have to leave it there forever.
Yeah, and I think that was a really good point that we had failed to make. There are some investment constraints.
Yeah.
And I don't think you can own international companies in these accounts.
No, I don't think so.
I think you have to buy US-based companies or a US-based index or an ETF. Now, whether or not that will prevent active managers from even having access to these accounts is yet to be seen. So I don't know if they legitimately mean you can only go to a passive ETF that is 100% US based, or if they mean you can own any ETF as long as the stocks are 100% US based. I'm not sure, because it said low cost, but I don't know what they mean by that.
I think it's going to be like a 401k, basically, where it's just, they have an approved list of options, basically. And I'll bet you they start out as U.S. growth indexes.
That makes sense to me. Yeah. I mean, and again, you could do worse. All right. I feel like we've touched on some of the ones that are probably most important.
Yeah.
And then we could go back and say there is one in the mortgage interest deductibility, which is if you are paying private mortgage insurance, I believe that you will be able to include that as part of your itemized deduction like you would mortgage interest. And again, these are all subject to various phase outs, whereas your private mortgage insurance, or PMI as it's well known, typically what people have to get if they don't quite put 20% down on a home, that was not ordinarily deductible. I think that is becoming deductible. And then one, I won't name names here, but gambling losses, yeah, they're going after gambling losses, Scott. So whereas gambling losses used to be 100% deductible against your gambling wins, such that if you had $500,000 in gambling winnings but $500,000 in gambling losses, you broke even from a tax perspective. You can never deduct your losses in excess of your wins, but now what they're saying is you can only deduct 90% of your losses against your wins. So I maybe this is a little bit of a wink and nod at trying to get people to not gamble so much. I don't know.
Have to talk to Hannah about this.
I think that our tax planning person did say that there was a bill immediately drafted to get this part of the code changed, like right away. So
sponsored by DraftKings.
I was gonna say how long this hangs in there. We'll see, but that's one that I thought was kind of interesting in there. And then there's a couple in here that, again, the people to whom this applies are just a very small, like qualified small business stock. There's some things in there where you can get a lot of tax-free appreciation on that. You've got to meet certain provisions, not necessarily as germane to the mass affluent who don't have probably qualified small business stock. But beyond that, I really feel like we've hit some of the highlights here.
I do too. The last one that I was just going to bring up, because it is a type of an account that our clients tend to have, is they've expanded the ability to use 529 accounts for non-college expenses. So right now you're maxed out at $10,000 per year that you can contribute to, say, private elementary, middle, high school. That beginning in 2026 is going to go up to $20,000. So that if you've got a very large 529 and you're sending your kid to private school, something that could help.
Could help. And I know we've touched on this before, and you have some thoughts on using your 529 as a strange kind of conduit where you think it's almost redundant, where you're saying you don't get an upfront tax deduction and then you can immediately pay that money out to pay for elementary school expenses. It's like, but all the benefit in the 529 is the difference between what you contributed and what it was worth when you distributed it. And it's like that's the same point we try to make to our clients on their IRA, their 401k, their Roth IRA. All of the benefit is really on distribution.
Yeah, and I think that situation, and I've heard about that, and we talked about it a little bit. That one I feel like is really leaned towards states that have an income tax.
Yeah.
So like in Texas, I just can't see any benefit for that.
And another way that I see it is if you have overfunded 529s and you have a child who, say, got a scholarship to college or what have you, ultimately maybe you've got other children or grandchildren where they are going into a private high school and you can immediately start to get some utility from this account. But kind of like our analysis with most of our clients with the Roth, it's saying, what are the benefits of waiting? What are the benefits of allowing this account to compound a little bit further so that we can cover costs out in the future? So kind of curious to see how that one goes. It kind of reminds me, or I would say it's an analogous situation to where sometimes you go to a casino, if you play slots, you put $1 in and they give you 50%, they give you 50 cents back and they call it a win. And you think, hang on a second.
Who's got the gambling problem now?
Yeah. I don't know. I think in some, and believe it or not, Scott and I really like this kind of stuff. And I think that more than anything, the changes to, because we off air, we're kind of tallying the available deductions for people who are taking the standard who are retired. So think about this. $31,500 is available for your standard deduction if you are anybody. You get an additional $3,200 if you're a married couple and both of you are over the age of 65. So that stacks on top. And now with the advent of this new senior deduction, which is sort of what's taking place of Social Security income being tax-free, there's another $12,000 at play.
No, this is, I think there's a ton of a possibility here to get effective rates down in 8-9%.
Yeah. And so if you are a person who is ordinarily taking the standard deduction, the available deductions to you now is $46,700 is out there. And so kind of what we alluded to before, and we haven't even started talking about IRMA and all the other stuff where these kinds of things, because they don't really play into IRMA at all, because remember, most of these new deductions are not above the line.
Yeah, they're on the line, as we've decided.
How these things coordinate with IRMA and all that kind of stuff, it is going to make the recognition of income, how you recognize it, when you recognize it, from what account, way, way more important, way more valuable, because you might step on a landmine and really miss out on a big deduction in an effort to do a little something or a little bit of planning that, had you sat down with a person who could provide you a little bit more insight, you could have done even more efficiently.
Yeah, so I think to summarize, whether you're working with us or somebody else in the industry, have a conversation about what is the most efficient way that I can take advantage of all these deductions and not accidentally walk into a phase out that you didn't know about.
Yeah. Well, that was our emergency broadcast on the One Big Beautiful Bill Act.
Our big, beautiful podcast.
Our one big, beautiful episode. So I imagine we'll probably have more episodes discussing these various things in greater detail, kind of as this shakes out, how we're seeing this play out for tax returns. But hopefully this will give some people something to go on here.
Yeah, I agree. And if this is content that you're enjoying, go ahead and hit like and subscribe on YouTube, Spotify, or Apple Podcasts.
Regarding the phase out of itemized deductions, we wanted to clarify some confusion. In the recording, it says maximum available deduction if you're itemizing caps out at 35%. That implies that you can only deduct 35% of your gifts, or that you can only offset 35% of your income with gifts. The actual rule is that the tax benefit, not the deduction amount, of your gift is capped at 35%. So under today's rules, if I'm in the top 37% tax bracket and I give $1,000 to charity, that gift reduces my tax bill by $370 or 37%. Next year, the tax benefit of that gift will be capped at 35%, meaning it would only reduce my tax bill by $350. Regarding the discussion of Trump savings accounts, we wanted to clarify that distributions are pro rata and they're not aggregated with other IRAs. It would be best to equate these to traditional IRAs with after-tax contributions, not to Roth accounts. Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.